And we got that going. So now we are officially on the clock. Hi, I'm Jeffrey Campos, President CEO of the Southwest Valley Chamber of Commerce. I want to welcome all of you to our roundtable discussion that we hold every other month. And this one's going to be access to capital. And just a little background on the access to capital part of it is that it's going to be part of a program that we're offering. We're excited to announce that we're going to introduce an 8-week course designed to help current businesses and individuals looking to grow or open a business. And our program is going to be called the Entrepreneurial Series. This program is going to be designed to take organizations to the next level, bring in entrepreneurs from creation phase to their new business ideas, providing hands-on learning experience on topics that include access to capital. That's going to be part of the what we're looking at. And we're also going to have, in addition to that, in the training, we're going to have marketing your business. And then we're also going to have some small business management. So this is kind of a teaser, if you want to call it that, on access to capital. We'll have a lot more, and you'll probably hear the same speaker as part of our entrepreneur series as we move forward. So we're excited about that. Let me introduce our panel members. We have Greg Tanner he's the founder and managing partner at Aspen Capital Fund. Greg has firsthand experience in building businesses from the ground up as an entrepreneur. His roles has been founder, CEOs, and sales. He does it all. As the founder of Aspen Capital Fund, Greg uses his understanding of business experience and professional network to offer the expertise for startups. He has an extensive experience preparing businesses for first stage investment, and Greg has participated in startup experts with over 60 early stage companies in his career. Welcome, Greg. Next, we're going to have Sergio Cardenas, Vice President and Middle Market Commercial Banking for Comerica Bank. Sergio is Vice President of Middle Market Banking. He graduated from Arizona State University with a Bachelor of Finance from W.P. Carey School of Business. He's built a successful relationship with business owners of small, medium, and large companies and has provided them with holistic views, ideas, and strategies and solutions to efficiently meet the financial needs of their companies in the Arizona market for over 16 years. He serves on the board of directors of the Arizona Hispanic Chamber of Commerce, the Arizona Community Foundation Professional Advisory Board, and is a native of the Valley. So let's also welcome Sergio Cardenas to our panel today. So let's start with Greg. Greg, welcome, and we're looking forward to your presentation. After the two presentations, we'll do a Q&A, and just submit your questions in the Q&A, and I will facilitate those as we complete the presentations.
Thanks.
Greg, welcome.
Thanks. Can I share my screen?
You sure can.
I cannot?
You can now, Greg, sorry.
Okay, that's okay. Hi, as Jeff said, my name is Greg Tanner. I'm the founder of Aspen Capital Fund. We have a small team of professionals here, and the number one reason entrepreneurs come to us is to learn how to raise capital and improve their relationships with investors. We're unique because we combine data, targeting, and content analysis as essential components to reaching and engaging investors. And through our consulting as a service, we offer investor databases, coaching, and feedback. We're always learning through working with investors. We have gained insight from interviews, discussions, and attending investor events. And investors have always shared the headaches and complaints that they constantly see, and they also share what they demand and the structures they like to see. If you have any questions, you can email myself or my team, just my info here. And I'm going to jump right in and start talking about what types of capital there is, and we'll focus specifically on um, the for the entrepreneur. There's three main pools of capital to draw: the debt capital, um, equity capital, which we're going to focus on today, and creative and alternative financing, which is a whole other college education course. So, and we'll talk today about equity capital raise. This is an alternative to debt capital or creative financing, and debt capital is probably something that Sergio will talk a little bit more, maybe even creative financing. So why would you do an equity capital raise? One, you'll probably want to sell interest in your company, and you want to raise anywhere from $10,000 to $1 million, and more importantly, you're a pre-revenue company. Equity capital is the term used to describe the capital that is given to a company in return for that company's stock or equity. With regards to debt and equity capital, at first glance, it seems that equity capital is less risky to business owners. Well, that's true, since there's no payment and no collateral. Equity capital is typically only provided to companies meeting specific criteria, which we'll talk about later. Also, with equity capital, the business owner forgoes a significant portion of the value created if and when the company reaches a liquidity event. For example, has an IPO or initial public offering, or is sold to another business. However, it is my experience that a small piece of a big company is better than a large piece of a small company. And if that equity capital is available to your company at reasonable terms, it is often a good decision to accept it. Finally, in our overview of capital, it's important to mention a hybrid of debt and equity known as a convertible note. Convertible notes are loans which are made to a company at a fixed rate of interest, which can either be redeemed for cash, like traditional debt capital, or can be converted into stock or equity in the company at a predetermined date or within a certain period. Convertible notes are preferred financing instrument for friends and family and some angel investments, since they allow investment without the difficult process of determining the price of each company's share. When seeking, equity investments, the source of capital is, for the most part, tied to stage of capital being raised. You see, equity capital is raised in stages or rounds. The 5 main stages include the following: pre-seed funding, seed funding, early stage investment, Series A and B, later stage investment, Series D, E, F, and so on, and then mezzanine financing. Most companies that raise capital are eventually acquired or go public, receive multiple rounds of financing first. If you intend to go big before selling or becoming public traded, there's no right or wrong answer here, but if your vision is then but if this is your vision, then it's important to consider when negotiating deal terms or on earlier stage financing rounds. You'll want to begin with the end in mind, not make arrangements with your angel or investor that will complicate the later stages of funding. If it's not your plan to get venture capital down the road, then you'll probably stop doing stage 2, receiving enough funding to boost your marketing, sales, and infrastructure to grow organically from there to the point where you are satisfied or are ready to sell. Here are the main stages of equity capital. Pre-seed funding refers to the initial capital to a company brings in. It comes from friends, family, members, credit cards, or whatever you can get. This could be as small as $5,000 and as high as $100,000. Though the dollar amounts are lower, this round is more difficult to get institutional funding for. Institutional funding is when a financial institution, rather than an individual person, funds you. Banks are not ready to make a small business loan to a company that has yet to launch, break even, or have an established track record. Nevertheless, when you get the startup money to kickstart your business with the bare essentials needed to begin making and fulfilling your first sales, Um, necessary machinery and like a website, your first batch of inventory, things you can't function without. That's what the stage is for. Put everything else on your wish list to buy revenues from sales or an additional financing. With this pre-seed funding, the company often perfects its business plan and strategy and starts building its management team in order to position itself for the next round of funding. Your first year or two in business is where your dreams merge with reality and take a new form to guide your future efforts. Many entrepreneurs end up taking their company in a different direction after some time spent testing on the initial business model. Take the founder of Wrigley Chewing Gum, who began selling baking powder and soap door to door and giving away gum as a bonus before discovering people actually wanted to buy it more than his soap. So during this round, you'll be testing what works and what doesn't. Here, you prepare to scale up the things that you do with future funding. It might be even a good thing not to have too much funding at this point of your business, so you don't have to invest too much going in a direction you'll abandon later. Number two, seed funding. Seed funding or seed capital typically ranges from 100K to 500K and is often provided by angel investors, which I'll talk a little bit later, and is usually structured as a convertible note or common stock. With seed funding, you hope to grow your business and at the very least gain proof of concept. That is, you'll use the funding to build a product or service and prove that customers want to buy it. At this point, be ready for institutional investors who can provide funding to scale or rapidly grow your business. Stage three, early stage investment, Series A and B. Series A is the term used to describe the first round of institutional funding for a venture. The name is derived from the class of preferred stock investors receive in return for their capital. The average Series A round is between 2 million and 5 million, with the expressed goals of funding early stage business operations. Providing enough capital for 1 or 2 years of operations, funds obtained from Series A can be used for the full gamut of needs from product development and marketing and to employee salaries. Series B is the round that follows the A round in early stage. In this round, you can generally raise 5 to 10 billion or million, excuse me, but sometimes you can raise up to 20 million in capital or more. The later stage investments, stage 4, like Series C, D, all the way to F, are further rounds of venture capital funding. Each round may raise between 5 and 20 million or more. And the later rounds are typically obtained from venture capital firms or strategic and corporate investors. Mezzanine financing or mezzanine capital is often provided by private equity companies and is capital provided either as equity, debt, or a convertible note that's provided to a company just prior to an IPO or an initial public offering. Mezzanine investors generally take less risk since the company is already solid and poised to cash out. And hopefully this lays out the different types of funding you can get and when. There's no sense going after venture capital if the time isn't right or if it's not needed to even reach your vision. For most of my clients, the main concern will be preparing the business for angel financing until the time is right for venture capital. So let's talk about individual and equity angel investors. As you recall, equity capital only earns a return when there is a liquidity event, like an IPO or it's maybe sold to another business. Individual equity transactions are ones whereby an individual, be it a friend, a family member, or other individual investing on their own behalf, like an angel investor, invests in your company. Note that sometimes individuals make debt investments, loans, to new ventures too. Friends and family, your friends and family are the most frequent starting point for entrepreneurs or business owners seeking that initial equity funding for their company. Your friends and family are the people that know you the best and will often put money behind the venture because they have trust in you and your vision for your company. Capital investments at this stage usually fall between 5,000 and 100,000, although investments near that upper ceiling are more frequently considered angel investments. Note that not all friends and family investments are equity investments. Some friends and family members take or make loans as well for their investment, or the investments are done as a convertible note. Angel investors, or the term angel investor, is defined as a private investor who offers financial backing to an entrepreneurial venture in return for the equity in venture. And angels also sometimes give loans. These angels are typically, excuse me, these angels typically provide more capital than friends and family, but less than a VC or a venture capital company. Specifically, angel financing, that their amounts are going to range anywhere from 50,000 to 500,000. For this money, and angel investors usually get about 10 to 35% equity of the company. Many, but not all, angel investors are accredited investors, and those are investors which have either a net worth of in excess of $1 million or have an annual income of $200,000 or more, or $300,000 more if you include their spouses. Accreditation is important because if you do not raise, because if you don't register your capital raise with the appropriate state and federal agencies, your investors must be accredited. If all of your investors are accredited, then you do not need to register your securities offering. The Raising Angel funding section, I'm going to talk about here, and the process of how you raise angel capital now. It's kind of a big topic, but I'm going to kind of just take you through for what an angels. So what do angels look for, or what do they look like, I should say? Let me go back here. Basically, the average angel investor is about 47 years old, high annual income of 90K, a net worth starting at about 750K, is college educated and has been self-employed and invests roughly about $35,000 to $40,000 per venture. The number of active angel investors in the United States is about 250K, which the SBA says. But there's another company called TNS Financial Services says that there's about 9.3 households in the United States with a net worth exceeding $1 million, and about 3 million of those probably have another million, excluding the primary homes. And I like to consider this 9.3 million figure to be the best estimate of the number of potential angel investors in the United States. The vast majority of these angel are latent angels, defined as individuals that have their net worth but have not necessarily made an investment. These are often the best potential investors in a venture since they have the funds but aren't bombarded by potential deals, unlike angel groups or VCs who are constantly bombarded. Most active angel investors are current, former entrepreneurs, some sort of successful executive, or otherwise just a wealthy individual. Note sometimes that a venture capitalist will see a deal that is not a good fit for their venture capital fund, which they personally like, and that thus they may invest personally as an angel investor. But as discussed earlier, angels are more often the individuals with extensive business experience who have operated and owned a successful business of their own. They often provide more value to your business than just the money that they invest. Last year, women angels represented 16.5% of the angel investor market. So why do angel investors invest? They like they think they can get, the reason why they like to invest in ventures like this or early stage, they think they can get a solid return on investment. Obviously, investing in the earliest stages for a company that eventually goes big can earn the investor anywhere up to 100 times their money or back or more. Angels expect an average of 26% on the annual return at the time they invest, and they believe that about 1/3 of their investments are going to result in a substantial capital loss. One thing they know that angels do, they know and like to trust the entrepreneur, like with friends and family. And sometimes angels know and trust the entrepreneurs and want to help them succeed. Angels feel that they can add real value. Many angels have lots of relevant experience that can help companies they fund, from experience hiring staff to connections with key potential customers or suppliers. If angels can see their involvement adding a lot of value to the company, they might be very interested in investing. Sometimes it's the angel wants or just likes the action. Angel investing is exciting. It's generally a higher risk, high reward version of the public stock market, but requires a little bit more entrepreneurial analysis, which is highly intriguing, especially for someone like me. Keeping these motivations in mind can help you secure angel investments for your business. The reason was, as I mentioned, angels often invest, they feel like, when they add real value, and virtually always only invest in when they understand the business. Also, their angels are known to invest in high tech and various different, but they do invest in like real estate. They do invest in restaurants, and if it's right for them, or they'll invest in retail as well. There's a lot of ego factors that go into every kind of deal. So depending on the type of angel investor, there's some sort of equity investment investor out there for you. What do they look for in a company? Angels most of all must believe the company has great potential to get some sort of liquid event, because that's how they end up making their money. The first criteria is scale, or the potential for a customer to achieve high annual revenues. If a company expects to raise venture capital after the angel round, it must have the potential to earn annual revenues from $50 to $100 million within 5 years. Conversely, an angel investor, when no follow-on capital is required, might be willing to invest in a website or a restaurant that has potential to generate hundreds of thousands or a few $1,000,000, as long as a clear path has been laid out regarding how they could get a sizable return on their investment. The second criteria is barriers to entry. Barriers to entries are those things that make it difficult for another firm to compete against you, such as patents, proprietary technology, a unique location, maybe long-term customer contracts. The third criteria is having a strong management team with relevant experience and success under their belts. Again, angels must believe in and be comfortable with both the founders and the key operating personnel of the company. The fourth criteria, angel investors need to feel confident of your exit strategy, mainly that the chances are good that eventually having another firm purchase your company, or maybe going public, is through your exit strategy that these investors profit from their investment in you. Another criteria, which is not necessarily tied to liquidity potential, is that angels investors don't tend to only invest in local companies. That's changed quite a bit since the pandemic, but angels do often like to invest in companies that are close by, so that they can visit often and participate in board meetings and other meetings. And finally, angel investors will only invest when the price is right. If you price your equity too high, then angels might not have the potential to reap the returns they're looking for, and they may not invest. So how do you find an angel investor? Individual angel investors can be found via referrals, networking at events, through multiple degrees of separation, focused prospecting. At Aspen Capital Fund, we call it an investor funnel. And referrals are a great way to get introduced to an angel investor, usually by a mutual acquaintance. Talk to your friends, family members, other professionals, your accountant, lawyer, and advisors, and see if either they can invest into your business or refer you to an angel who can. A lot of times angel investors will say no. You shouldn't stop there. Angel investors generally know other angels, and so they always ask for referrals. They're always the high quality and most fruitful referrals when you're out networking. If you can't find referrals to angel investors from your current network, expand your network. attend events constantly, ask constantly for more introductions from your existing contacts, and it takes a lot of time and diligence. You got to stick with it. Google raised its angel round of capital. Founders Page and Brin told their ideas to others in hopes so that they would get great advice and connections, and it worked. They discussed their concept with a computer science professor, David Cheriton, and then David Cheriton introduced them to his friend Andy Bechtolsheim, and Bechtolsheim wrote Google a check for 100,000. And then Google raised more money from friends and family, and then continued to grow their network, and obviously so on and so on, and that continued success was the Google.com story. So if you know quality people, speak to them and get them to refer you to other people. I like to talk a little bit more with focused prospecting for angel investors. With that 9.3 million potential of angel investors for your venture, you just got to know how to find them. I really would take a good hard look at this investor funnel and learn how to use it. I could talk another hour about that.
And you got 1 minute, Greg.
Okay. So let me just go summarize. Begin with the end in mind, like I said. Create a list of prospective angel investors by networking and prospecting. Connect and meet angel investors. Establish your terms of agreement. Keep it simple. Get your financing check. I could go on and on. I'll go ahead and stop there.
All right, great. Thank you, Greg.
Thank you.
Now it gives me great pleasure to introduce Sergio again. Sergio's with Comerica Bank. Sergio, it's all yours.
Thank you. Joanna, if you could put the presentation up, please. Perfect. If you can get it centered, that'd be great. I'll go ahead and start. Good afternoon, and my name is Sergio Cardenas. I'm Middle Market Commercial Banking Vice President for Comerica Bank here in Phoenix, Arizona. Thank you for joining us today for the Southwest Valley Roundtable. Hopefully you'll get a better understanding of what access to capital is. If you go to the next slide. Some of the topics that I'm going to go over are, it has to do with the banking relationship, because that is one of the main things when it comes to having access to capital is having a banking relationship. So one thing that I'm going to go over is what is business banking? Why is it important to have a business relationship with a bank? Preparing your business for success, what it takes to get business loans, how to present your business to a bank, typical credit requirements, getting proper advocates for your business, and what a business banking relationship should look like. Next slide, please. What is business banking and what makes it so important for a business relationship? It's important to have a great relationship with your bank, especially if you want your business to grow over time. Now, what do I mean by this? You want to align with a bank that can understand your business, industry, products, and services you provide. By understanding your business, this bank can support your business and help your growth strategy with access to capital. Supporting the growth would be through lines of credit, equipment loans, real estate financing of a building that your business will occupy, or for manufacturing needs. Access to capital is key when it comes to starting a business, as Greg said, and having one that is already established is obviously helps. The vast majority of entrepreneurs need financing to assist these startup costs and grow their business. I've read in a 2016 annual survey of entrepreneurs that shows that only 5% to 10% of businesses have that capital in order for them to pay their employees and have those startup costs. However, between 90 and 95% of entrepreneurs that hire employees, they don't have this capital, so they need to get it from somewhere. Next slide, please. So one of the important things is legal entity structure. This is what banks look at when it comes to establishing your business. So it is good also when it comes to tax planning. So you would want to consult a CPA, an attorney, who you're able to understand how you want to be taxed when it comes to your profits. This is key when establishing your business, already have a business in place. At the end of the day, you want to be able to have sufficient amount of profits to reinvest into your company rather than giving it away through taxes. Establishing a bank account. I know that sounds very, very simple, but it's very important. Have one for each entity if you have multiple businesses. Don't use a personal account as it defeats the purpose of having a legal entity set up. You can pierce the corporate veil by mingling business funds with personal funds if you don't have an appropriate account set up for your business. Piercing the corporate veil refers to a situation where courts put aside limited liability and hold a corporation's shareholders and directors personally liable for the corporation's actions and debts. Veil piercing is most common in close corporations, and this is why it is important to keep transactions separate in a business account and not in a personal account. Creating a budget. Even well-established businesses may not have a budget or forecast for the year. It's good to understand your fixed costs and variable costs so that if you have to cut expenses during a downturn, you know where you can cut it and where you can't. Having a budget is also great for planning purposes. A yearly and even monthly budget allows you to understand trends of your business and what expectations you may have had for sales and expenses and how you can manage to that budget. This is also a great tool to see where you can create more efficiencies in growing your business. Next slide, please. Bookkeeping. One of the things I have noticed over the past 16 years in banking is that it's important to have good bookkeeping. Even though you have an accountant to look over your books or do a review or an audit, it is important to have the right kind of person and software to keep track of your business finances. For companies, there are several software solutions that fit each size of business and support that software that comes with it for you. You can also work with an accountant or company that provides bookkeeping services. How much is in the bank isn't always a determining factor of how you are making your money and how successful your business is. You can miss out on good opportunities or not even understand where you're losing money before it's too late. You can miss out on good opportunities and understand margins, costs affecting them, and when you have good financial statements, this is what you're able to do. It is also good to understand cash versus accrual statements. Small businesses usually use cash, but large organizations use accrual. Cash basis is where you recognize revenue when cash is received and expenses are recorded when cash is paid. Accrual basis is where you recognize revenue when it is earned and expenses are recognized when it is incurred. The main difference between accrual and a cash basis accounting lies in timing of when revenue and expenses are recognized. The cash basis method is more immediate recognition of revenues and expenses, while the accrual method focuses on anticipated revenue and expenses. The advantage of the accrual method is that it includes accounts receivable, accounts payable, and as a result is a more accurate picture of profitability of a company, particularly when it comes to long term. Next slide, please. Oh, sorry, talk to your accountant about which one is best. Knowing your competition. Knowing your competition is very important. What company provides the same products and services that you do? How are you different? It's important to advertise your expertise and your competitive advantage over your competition. Knowing your customer base. Who is your target market and how can you increase it? Are you selling your services to an older demographic or a younger demographic? What price point makes sense for your product and services for that demographic, and how can you make them incline toward your product over competition? Brand awareness. Good examples of brand awareness are companies like Tesla, Apple, Google, Amazon. Each of these brands are known for their experience that customers have with their product or service. Tesla has been a disruptor in the conventional car market and has changed how people view cars and their driving experience. Apple first came out with the iPhone in 2007. They changed the whole cell phone industry with their product. Amazon started an online bookstore. Now they compete with every retailer in the world, and it has changed the way consumers shop today. These are good examples of brand awareness. Have a growth mindset for success. Challenges in the business are opportunities for growth. Instead of having a fixed mindset where you think, I'll stick to what I know, either I'm good at it or not. Having growth mindset would be, I want to learn new things. I'm eager to take risks. Fixed mindset would be, this is a waste of time. There's a lot to figure out. Or I know this will help me even though it's difficult. Those are just some examples of having a growth mindset and changing your mindset when it comes to success. Next slide. Personal credit. Now we're going to go to more of the understanding of what it is for financials, personal credit, all the things that banks look at. Personal credit. Make sure your personal credit is good. Most banks look at personal credit as an indicator of how you will manage your finances for your business. If you can't manage your personal finances, how can they trust you on how you will manage your business finances? Business financial statements. Accuracy of your business financial statements. It is key to have good understanding of how your company makes money and the key areas where you need to improve on, so that when it comes to questions that the bank asks you, you understand your financials. This gives the bank confidence in your understanding of your business. The accuracy of your finances is key. If there is clear mistakes in the financials, the bank will doubt the validity of the financials and may not approve the loan just because of that. Telling the story. Telling a story is important when it comes to a bank understanding your business. How did you build your successful business to where it is today? Banks always want to know what it is that drives you every day on a day-to-day basis in your business, keeping it going for the future. How are you profitable? If you don't know exactly how your business makes money, you don't know what costs, your cost of goods sold are, your overhead costs are, then they can't understand how you know that your business is successful. Next slide, please. How to present your business to the bank. These are general requirements that banks look at. So they look at 2 to 3 years business financial statements. They look at 2 to 3 years tax returns, 2 to 3 years personal tax returns, a year-to-date profit and loss and balance sheet, personal financial statement. Next slide, please. Company background. It is good to have a summary of your company, what it does, products it sells, who are your competitors, what is your plan for growth, what factors affect your business, and how are you taking advantage of some of those factors that affect your business, either to reduce risk or to take opportunities where you can gain market share. Next slide, please. Management. Who runs the day-to-day operations? Who books? Who runs the sales of the company? What are the qualifications of each person? It is good to have some sort of either bio or resume for these specific people, whether it's you, if it's a mom and pop shop where it's a husband and wife, it's good to have some sort of information on the management and how they work together in order to make the business successful. Next slide, please. So I just wanted to give you, these are very general, I guess you could say, requirements. Different banks may be different when it comes to, what they do on their side, but this is a very generalized in terms of the credit requirements. So very small, a loan of 25,000. Usually it's a score-driven application. They usually want to say 2 years in business, credit score of 620, and now I know that's a bit low, but some allow a 620 credit score or higher. They need to understand what your revenue is, your income, and your assets are. So that will be part of the application. They will also want to understand your personal income, other personal assets, and information outside of the business. Next slide, please. $100,000 line or loan may also be score driven. Minimum 2 years in business. They may require two years of business and personal tax returns, 2 years business financial statements, credit score of 620 or higher, and then also personal financial statement. Next slide, please. So for $1 million line of credit or greater, I'm going to say it in that way, and sometimes it could be $500,000 or more, or $250,000 or more. They're going to do a more in-depth look. They're going to look at 3 years business tax returns, 3 years personal tax returns, including all the Schedule K-1s, 3 years business financial statements. They probably want to look at it on an accrual basis rather than a cash basis. A business debt schedule. So they're going to look at what kind of debts you have on your business, who you owe them to, what the maturity is on them, what the start date was, and what the rate is, what the collateral. They want to look at your personal financial statement. Usually your credit score is going to be higher, so 680 and above. And even at that, they may look at 700 and above. For a line of credit, they're going to look at accounts payable aging. They're going to look at accounts receivable aging. And if you actually create a product or manufacture it, then they're going to definitely look at an inventory report. Next slide, please. Getting proper advocates for your business. Who is your relationship manager? Who do you know who to call when you need somebody from your bank? Does that person know your business? Do you talk to your banker on a regular basis? So all this is very important to have somebody that knows your business at the bank that can be an advocate for you. You want to establish a relationship with a bank so that when it comes to financing either a product or a service or something that you're going to do in the future and you need that capital, it is good to have a great relationship with your bank. Next slide. What does this look like? As you can see in this picture, you're the center. You want a dedicated team. You want direct access to a decision maker with those people that are your relationship manager, because they may have a manager on top of that, or a credit officer who they're going to be speaking to. And not only that, but they can provide you with proactive, meaningful conversations, consultations of what you may need in order to be approved for a loan. They can also provide customized solutions when it comes to your needs. And then the experience that they have, you want to make sure this person has the experience in understanding your business. So all these different things are great when it comes to establishing a business banking relationship when it comes to access to capital. Next slide. We're done. I tried to keep it within the 20 minutes that I had, so hopefully that was good. I know I spoke very fast.
Little early. You were a little
Okay,
early.
good.
I'm proud of you, Sergio.
Good. No, I just, it's important when it comes to access to capital. There's the family and friends that Greg mentioned before. But when it comes to access to capital, it truly is, when it comes to a banking relationship, is to have an established banking relationship. All those other things that I mentioned in my presentation, those are things that banks look at. They want to see how well established your business is. Even if you're starting up, you want to set the proper structure. And those are the different things when it comes to that. And so the more things that you have in line, the better it is when it comes to accessing capital.
Okay, great. Thank you, gentlemen. So you can see we did two different perspectives on how to access capital and how to prepare for it. So Now we're going to be open it up for some questions. Do we have some questions from the audience? Just write them in the chat and I'll ask them, or we could actually, I think, just let people ask.
I have a question for Sergio.
Sure.
So Sergio, I've been banking with Chase for a couple of decades now.
Yeah.
And in the beginning, I had a great manager and a great relationship with her, and she moved on. And now I'm finding it hard to, I think, just make a connection with somebody because I feel like maybe they're turning over a little bit more, maybe, or they've
Yep.
reduced the number of business managers. Do you suggest that I leave Chase and look for a different bank? Because I do actually love all their products and I like, everything that they offer. The only thing I lack is being able to put my thumb on someone and be friends with them.
So I'm just going to give you my personal opinion. It's good to have an established relationship with a bank, and that is through your relationship manager. I'm not going to tell you whether you should leave Chase or not. There's many great organizations that are out there, and as you mentioned, they have great products and services that they provide to you. But the key to that is that relationship and that person that's managing your relationship, because they're going to be attentive to you. And when it comes to getting a business loan, especially for you, with your organization, and you've had 20 years, right, that you've had with them, you want to make sure that they're telling your story. So if that means that you have to leave them and go to a different bank, then find that person that's going to tell your story. Find that person that's going to be your advocate. Find that person that is going to look at your business and see value in it. Because what that's going to do for you is, if you're looking to grow your business, when it comes to either, buying a building, because you have to have more employees and you have, your growth is tremendous, or you have a line of credit because you want to acquire, some other businesses, or you're looking to do other things with that line of credit that will help you, when it comes to your payroll, to hire additional people in order for them to go get more business for you. That relationship is key, especially when it comes to business banking. That relationship is key to understanding your business and being able to tell that story to their credit folks. I'll give you an example. And I could tell you an example for me, or I can tell you an example for another one. But this is just of recently. I heard of a friend of mine. He was at a different bank. They were looking at a specific, loan for them, and he wasn't able to get it done. That person went across the street. They were able to get it done, and that's what the business needed for growth. And so having that relationship was key. Same thing. I was able to get an approval within 2.5 weeks. We were given the request. It was a $10.5 million request. And because of my timing and because of the way that I do business, I was able to get an approval in 2.5 weeks on $10.5 million. It makes a difference. It depends on who is managing your relationship. And it also depends on what, like you said, the products and services they're able to provide. So it is key to having that business relationship.
I definitely agree. I guess you answered my question, but I had a great relationship with my banker. I grew my first business, real big business, and I sold it because of her. I mean, but then, she up and left and went there, some bank in Georgia somewhere, to another bank. So I see these other questions, Jeff.
Yep, we have a couple on there.
So the numbers changing for stage one. No, generally, like those rounds are pretty much kind of set in stone. I mean, unless you're a very, a big business or you're starting a big business. But they all start somewhere in some of that, in those relative ranges. I think the second question was for you, Sergio.
Do these numbers change outside of those ranges? Which one?
thinking back to Robert Kawasaki and his 4 quadrants, do the requirements of a lots of personal details still pertain to B? The B's on the top right.
I think that's yours.
If I can come off mute, I can explain that question a little bit further.
Yes, go ahead.
Right,
Please
thank you,
do.
sir. Yeah, no, so it is for Sergio, and one of your slides, you were you basically were showing that actually in a couple of them that they required a lot of personal like guarantee. Essentially, is the feeling that I got from it. Is there for bigger business? I run a fleet of trucking companies, which is also why I asked the first question, because 100 grand isn't really going to do a whole lot. I can't even get a truck for that.
Yeah.
But yeah, so it's thinking of Robert Kiyosaki and then like the businesses on the top right for bigger businesses. Is there any other way to get around that PG?
There is. The bank would have to be comfortable with your business size, your so these are going to be banking terms. If you need me to explain them, I can definitely do that. But EBITDA, usually if you have a significant EBITDA, then they're going to start looking at not having personal guarantees. If your business is probably, going beyond 30 to 40 to 50 million, and your EBITDA is, maybe 5 to 10 to 20 million in EBITDA, then they're definitely going to look at not having a guarantee. And the reason why I mention that is because when it comes to that size of business, you're looking to have a very large organization. You're going to have probably reviewed or audited financial statements. You're going to have management in place to understand your books, either CFO, controller, and then they're going to understand that, okay, here's what they have. They may require an audit for that, but they're looking at your organization as a very good risk when it comes to lending money and not have to lean on you personally when it comes to that personal guarantee.
Okay,
So,
cool, yeah. And I'm paying on a
so
lot
yeah,
of that stuff. Mainly get to about that 10 million mark, and then I can stop with the PG stuff. Basically, it's kind of the short version of that.
I wouldn't necessarily say that. I would probably say it's 30 to and up, and some banks still have personal guarantees for organizations that have 100 to 150 million in annual revenues. So it's different per bank. But here's the other side of the coin. The personal guarantee is there as a backstop. It's not the primary source of what we call the primary source of repayment. So they're going to look at the business as the primary source of repayment, the operations. They're going to look secondarily to the collateral. And then third is going to be the personal guarantee. The personal guarantee is more of just you saying, I give my stamp of approval to my organization because I feel you don't even have to come to me because I think but I'm going to pay you back. So that's why there's personal guarantees. But I definitely understand you. I understand when it comes to, personally guaranteeing and having all these different things, but I understand where you're getting to.
No, I appreciate it. Thanks, sir. And yeah,
You're
we're
welcome.
profitable. I'm just trying to figure out how to grow now.
Well, lines of credits, equipment financing, that's what we do.
Awesome. I'll look up all three on LinkedIn.
Sounds good.
Gentlemen, if you would want to maybe make some closing comments and also put your contact information in the chat for any of the attendees.
Sorry, we're putting my information in there.
Greg, I think you're all set. You want to start off, Greg? Any closing comments?
The topic of raising capital is ginormous. Get an advisor, get some help. If you're going to go out and raise funding, reach out to me and plan.
Sergio, how about you?
Yeah, it's important to have that relationship as I discussed before. It's important to establish your business with the right entity to get an account opened up. It's important to have even, family, friends, advisors, people who can help you out when it comes to starting your business, or even as you're growing your business, hiring the right people, having the right people on your team, and then, obviously having that key relationship when it comes to access to capital.
Great. Well, gentlemen, I appreciate your time today, and this is recorded, so everybody has an opportunity to share it with anybody else that may want to get this information. It'll be on our website, it'll be in our social media, it'll be everywhere. So thank you again, gentlemen, for coming, and we look forward to you participating in our entrepreneurial series as we move forward and continue to support businesses in the Southwest Valley. Thank you all. Everybody else, have a great afternoon, and we look forward to seeing you again.
Thank you.
Thank you.
Thank you.